Hello, this is Yaro, and welcome to another exciting podcast today. I'm looking forward to talking to Elizabeth Yin. Elizabeth, going to say hello straight away. Thank you for joining me.
Thank you for having me.
So I know a bit about your background. I honestly mostly know you for your current your fund, Hustle Fund. I see you on Twitter a lot. You're definitely doing something a little different there. I think I'm not even sure. We may have even had a semi-pitch conversation at one point about one of my startups. I wasn't sure if it was you or not, but we can bring that up later on. But excuse me, I am interested in so many of the things you're doing, but can we just give the audience a summary of what is Hustle Fund and what might make it different from another VC firm that people are probably more used to?
Certainly. So I think for Hustle Fund at a high level, our mission is to really help with essentially three things. I think, there are a lot of hustlers, so to speak, out there, a lot of great entrepreneurs in the world. But when you think about the resources they need, which is namely capital, networks, and knowledge, it isn't really distributed well worldwide. The best entrepreneurs don't necessarily get those three things. And so our mission at Hustle Fund is actually to further those three things for all entrepreneurs, and then also for the very best entrepreneurs, also make sure that they can have access to those resources. So we have a VC fund as part of the larger Hustle Fund organization, and the VC fund is a pre-seed software fund. And so we invest pre-traction. That's what I mean by pre-seed. And we invest relatively globally these days.
Okay. So like when you say pre-seed and pre-traction, you're talking about generally like it could be a team or a person just with an idea. They haven't got a customer yet, maybe not even a website or an app yet. They just come to you with an idea. Is that correct?
Well, we like people to have done something because anybody can have thought of an idea yesterday.
Sure. Yeah.
But I would say so for most companies we invest in, they do have some semblance of a product. Now, it could be a concierge product or some sort of manual product. It could be a product that you can put together in 1 hour using a bunch of forms. So it doesn't necessarily need to be a product that you have spent the last 3 months building out. The point is we want people to have given thought to their customer development and really prioritize de-risking, customer acquisition. So what is the thing that you're going to do? If it's product, well, what is the simplest product that you can put out there to start testing? Or in some cases, nobody has a product yet, but they have a wait list, or maybe they've done some pre-sales and there's no product. So that's kind of the stage where we play, where you are really thinking about how do you de-risk, sort of a la lean startup, the customer acquisition component. And we like to see people start to have done that.
Okay, so there's definitely more than just an idea there. There's something going on behind the scenes. Now, I know based on like the website and what I've read about you before, your typical check size is sort of that $25,000 mark, which I am been doing some angel investing myself, and that's kind of the sort of price point, maybe a little bit less sometimes as well, but that's the ballpark. What is the difference between, say, a hustle fund $25,000 check versus an individual angel investor $25,000 check? And do they necessarily come at the same time? Like, where does it fit in the chronology of a startup?
Yeah, we very often invest alongside other angels. So actually, I do think that a good way to look at Hustle Fund is as an angel. I think, from a legal perspective, our money does come in the form of a fund from other people, but I think we are very angel-esque in many ways. So many operator angels can be helpful with advice and network and that kind of thing. And similarly for Hustle Fund, we run programs like we have something called Redwood School, which is free to our portfolio. And we bring in a number of mentors who can tactically give advice to our portfolio companies on things like outbound sales or lead gen or whatever. So we do try to provide more than just money. We've also done so many introductions from a fundraising perspective to other investors to help you round up more money than the 25K. So we see ourselves not just as a 25K check, and I would say that probably most of our entrepreneurs would say that as well, that the bigger value add are these other things.
Mm-hmm. Yeah, I think that might be the key difference, where an angel would potentially just, here's your money, good luck, keep me in touch, where you might be stepping in and actually supporting, helping you do more introductions, connections and so on. I'd love to talk more about that process, but I do want to know how the Elizabeth background connects to all of this as well. Obviously, to get into this world, it usually results in someone having had an entrepreneurial experience to begin with, possibly an investing experience as well. I know your background in terms of your LinkedIn profile. Obviously, you were a Google product manager, and that was the sort of, I wouldn't say super early days at Google, but certainly early enough days. I'd love to ask you a little bit about that, if there's a story to share there, of course. But even before that, can we go back? Are you born and raised in the Bay Area or somewhere else?
Yep.
Okay, so
Yep.
you're original Bay. Did you grow up then, and maybe this is cliche, but seeing entrepreneurship everywhere, and that was something you thought you'd obviously get into, or maybe tech might be the other, not necessarily as an entrepreneur founder, but certainly working for a tech company? Is that what everyone in the Bay who grows up there thinks about, or are there other options in the Bay?
Yeah, for sure. I think definitely time and place has had a huge influence on my life. My parents were not in tech and they were not entrepreneurs. So, where I got my influence on that was definitely in growing up here. In fact, actually, something very distinct happened to me in high school, my freshman year of high school. My best friend Jennifer asked me if I wanted to help her cousin Tony with his startup during winter break, just helping them do little things here and there. And I didn't have anything going on, and so I said, okay, sure. And so we took the Caltrain up to San Francisco, and we went to his office, and that was where I got my first taste of what a startup was. It was like Tony and all of his friends, and they were kind of doing all these things, and they could eat all the pizza they wanted in the world, and it was the dream. And so that's when I knew that I wanted to start a company, and this was in 1996. So it's the start of the rise of the dot-com boom around here. Now, I never even thought very deeply about how do startups make money? How does this all work? But 2 years later, that, aforementioned Tony actually ended up selling his company to Microsoft for hundreds of millions of dollars. So he was quite successful. And many of you may actually better know him as the late Tony Hsieh, who was the CEO of Zappos. So I was very fortunate very early on in life to be able to, run into somebody who would become sort of a lifelong mentor, or at least up until last year. Mm-hmm. And, so things like that had a big impact on my life. And he would later have a big impact on my startup career as well, continued from that. And his cousin actually was my co-founder at LaunchBit.
Oh, I didn't know that. Wow. Tony's had a lot of influence. I've spoken to a number of entrepreneurs who seem to have connected with them at some point. Maybe just for the sake of connecting the dots with Tony in your early life, what did you take away from him as a founder? Because that would have potentially influenced how you saw yourself becoming a founder as well. Were there certain traits or attitudes or anything, work ethic, that you took away from seeing what he did and how he did it?
Well, I think like many entrepreneurs, Tony certainly worked really hard, but I think there are a couple of things that he did differently from many people. So one is he really thought outside of the box. I think a lot of entrepreneurs think outside of the box because that's kind of what you have to do almost by definition to be an entrepreneur, to be scrappy and make things work. But, he was very early in, for example, geography. And what I mean by that is, Zappos was in San Francisco, and he quickly realized, well, from a business perspective, this makes no sense. I can't afford to hire people for customer service here. And there are much better people, talent-wise, who do customer service elsewhere. So he was very early in deciding to move the whole company to Henderson in Nevada, near Las Vegas. And I think that's just a decision that most people would not have made at that point in time. This is 20 years ago when he made that decision. And only now are people starting to say that you can build a big company outside of Silicon Valley. And so, that's sort of, I think, one example of many. He later made a second decision in a similar vein for Zappos in deciding to move the company to downtown Las Vegas. A lot of people thought he was crazy, whereas you already have something that is working in Henderson. And at the time, downtown Las Vegas was just honestly really unsafe and had a lot to be desired. So people just thought he was nuts. But I think even fast forward now, if anybody has been to downtown Las Vegas in the last couple of years, people will see actually he's really changed the place quite a bit. And, I think it's pretty incredible, his ability to kind of, see through some of what other people might consider nutty.
Yeah, he's definitely made a mark on Vegas. I know that. In fact, the few entrepreneurs I've heard connected with Tony seem to be connected with Vegas as well. So there's definitely a link there. Could you take us forward with your own story? So you meet Tony, you see that lifestyle as a startup founder, you see the potential big exit as well. No doubt, that's exciting. You have his cousin as a potential co-founder. And it was the late 90s, so that was a crazy time. I started my first website in that time frame, obviously because everything was going on at that time. What were you thinking in terms of your first business or your first attempt at doing a startup?
Well, so because that was very inspiring, actually, Jennifer and I started building websites together in high school around that time after, spending a couple of days with Tony. And so we just built websites and sort of like an agency type of model, not, right. It was not a product business by any means, but we just worked on a lot of websites in our computer lab at school. And that's what we spent a lot of our time doing, during those years.
So what happened after that? So you kind of were, I guess, sounds like a side hustle maybe, or an agency business where you can make a living from it. Did that eventually turn into something else, or did you just, give it up when a new idea came along?
No, it was just sort of a little side hustle. We were still high school students, so,
okay.
We didn't really take that anywhere. And then it's funny because, like, to me, in some sense, the dot-com bust feels like it never happened because I was so sheltered from it. I graduated from high school in 2000, and I went to college in late 2000, which was when the bust happened. So I was in school for the next 4 years in college, and, meanwhile, all around me, literally all around me, because I was still in the Bay Area in college, like, everything was just shutting down. You would see headlines in the paper saying, any IT jobs are going to India, and, the internet is dead, and all this other stuff, which obviously all of us find laughable today, but I was sheltered during that whole period of time. When I emerged from college and graduated in 2004, I wouldn't say that everything had come back, but the tech economy had started recovering at least.
What did you study in college?
I studied electrical engineering.
Okay, so you graduate. What was the plan upon graduation?
Well, I think to some extent, though, a big, I guess, fear was getting a job. And maybe that's a fear for everybody, but I think even more so having gone to college during that era. And part of why I studied engineering was I thought that if computer science is dead, maybe I should do something that's a little bit more flexible or broad. And but as it would turn out, actually through a sort of meandering path, I ended up getting a job actually in Tokyo. And I did, I guess you could call it sales or marketing engineering out there.
Okay.
After graduation.
Okay, so a bit of a travel experience as well. That'd be a lot of fun. How long were you in Tokyo before?
I was in Tokyo for about a year. So actually the way that this came about was just also very unexpected. I actually originally thought, oh, maybe I might like to go to business school right after graduation. And so I wanted to see a couple of campuses in Boston, but I didn't really have the money to pay for, a trip to go out to Boston. So I entered this contest, and the prize for the contest was free plane tickets to go to their conference in Boston. Anyway, I won this contest, and so I got, a free flight to Boston. But in order to get my reimbursement, I needed to go to this conference, which had a large job fair. And this job fair was not just any job fair. It was a job fair it was the largest job fair for jobs in Japan, and it's held in Boston every year.
Okay.
So I ended up getting a job on the spot. Yeah. I ended up getting a job on the spot. I didn't get into any business school, and so that's how I ended up there. So you could say that I wasn't really looking to take this job per se, but it was certainly an adventure for about a year.
Okay. Now, when does Google come into this? Because we're hitting close to the years you worked at Google. So did you come back from Japan and then look for another job, or were you still working in the same company?
Well, so then the thing about that job is that I wasn't really qualified for that job either. So I got there in October, and pretty much by the end of October or early November, they pulled me aside and pretty much fired me. They said, this isn't working out. Your Japanese is not that good, and so you're going to have to leave. And so they said you can stick around for about a year. We can kind of put you in the back, and you can do some PowerPoint presentations for us, but we don't want you talking to customers. So that's how my job ended up. So I needed to find something else, and so I reapplied to business school that fall. I submitted the same essays and letters of recommendation and test scores and everything because I had no time to redo anything. And this time I did get in. So I went to business school for a couple of years, and then after that took a job at Google.
Okay. So tell me about Google. Life-changing experience, or really boring, somewhere in the middle? What was it like?
Google had amazing people, and maybe they still have amazing people to this day. I think they hired, when I was there, incredibly well. The bar was so high. Everybody was very sharp. I thought quite highly of my colleagues. And obviously the environment has a lot of perks as well. Like the food, at least back then, was amazing. But I felt like even back then, and this was in 2007, it was quite big already as a company. I think there were over 20,000 people who worked there at that time. And even bigger still today. But I think, back then I just felt like, wow, this is really big. I'm not sure this is really quite the right environment for me. And so I left because I wanted to start my own company, which is almost the opposite of a really big company, to start your own company by yourself. And I decided to leave in late 2008. And so from a timing perspective, I had thought, okay, I'm going to turn in my resignation in a couple of weeks. And next thing I know, you read TechCrunch, and there's this article, Rest in Peace, Good Times, where Sequoia essentially sent out this email to all of their, founders or somebody saying, we're going to batten down the hatches. We're not investing in new companies and all of that. And I paused and thought for a moment, maybe I shouldn't do this startup thing. Maybe I should wait it out. But then I thought, if I wait it out, what sign am I looking for? What am I waiting for? So I decided to take the plunge and leave.
At the time, were you thinking you need investment? Like, I can understand, obviously, like you said, Sequoia was batting down the hatches, and I do remember that actually going out and a lot of news around the lack of capital at the time. But you had the experience, maybe obviously it was in your teenage years, but running a company that I'm assuming your agency did not need investment capital, right? So you knew it's possible to start a side hustle that maybe could turn into a venture-backed company down the track. But were you sort of thinking from the beginning, no, I want to do, day one, find investors and grow like that?
So this is a great question because I think in reflecting back, I didn't really understand what venture capital was. I also didn't understand who should raise it and what for and why and what timing and all. I didn't understand any of that. But, I think the ethos around here is, oh, that's what you should do. So I think that's kind of how I got, in that train of thought. But I think I was actually just not able to raise any capital for those first couple of years. And it was a good thing because I also had no idea what I was doing either. And I actually had saved up a fair bit of money in preparation to do this. Like I was working at Google and pretty much saving everything. And because I'm from the Bay Area, this may be really privileged, but I just crashed with my parents that whole time. So I wasn't spending any money that I was making at Google, except for maybe on taxes, right? Because I was just at home eating Google's food. I biked to work, so I didn't even have a car. I didn't have any expenses really. So I was in good shape, but I think the venture capital story is just very confusing.
It is interesting given what you do today. no doubt, advising certain, early stage companies, should they take investment or not. You kind of went through it a little bit. Yeah, I can imagine, though, you would have been your own kind of capital source, obviously saving so much money from Google with almost no expenses. So that's amazing. What is the idea, though? What were you thinking, and how did you come up with the idea for this business that you worked on for 2 years? It sounds like without financial backing, but did you have a co-founder or anything like that?
So I had a lot of meandering ideas, and that was, I think, problem number one. Like, I just knew I wanted to be in business for myself. There wasn't a particular problem I was trying to solve. And I think in retrospect, people should really have a problem they want to solve or an audience that they want to solve for. Certainly before they try to raise any venture money. And so we had a lot of different things. At this time, I was working with a friend from school, not Jennifer, but somebody else. And we had a co-browsing tool, like you could shop with somebody else. And we had all these other, side project things. So it was not very buttoned up. There were a lot of explorations and a lot of learnings at this point in time.
Okay. And the end result, I'm assuming eventually was LaunchBit. Is that right?
That was a lot later. And so anyway, that co-founder decided that he didn't want to do startups, so he left.
Okay.
And then later, at some point, I arm twisted my friend Jennifer into, hey, you're finishing up grad school. Why don't we work on a company together? And we, just ended up actually building out an ad network. So there were just like a lot of side projects in there with different people and different angles. And at some point, we were even doing affiliate marketing, selling all kinds of other stuff.
Okay, well, we probably were possibly crossing paths digitally at that time, because that's when I was doing affiliate marketing, blogging, early day podcasting as well. And this is funny too, I actually had an idea for an ad network at the time, which was kind of similar to what BuySellAds ended up being, the company that acquired your company. We had Todd on the podcast many years ago. I think 4 years ago, I had Todd on the show. I'm not sure if he was the person you did work with. Okay, I'd love to hear more about that. Okay, awesome. But so tell me a little bit more so what is LaunchBit, and is it like that you said you had an ad network? Is that kind of like the genesis of what became LaunchBit?
So at some point, after all of this floundering, Eric Ries wrote a blog article that I really feel changed my life. Like, if you had to pick out pivotal points in your startup journey, meeting Tony was one. Reading Eric Ries's blog article was probably the second one. And so essentially the article was the gist of what later would become his book, Lean Startup, which many people here have read. And I realized, we're doing everything all wrong. We're just like building out all these things, but we're not actually figuring out if people want to pay for anything or whatever, and just spending a lot of time building. And that the number one problem for most startups, or most software startups, I should say, is do you have a product that people want and they're willing to pay for? Like the customer acquisition piece, like, does that make sense and does it work out? And it was, as funny as it sounds, because it sounds so stupid saying this out loud, but it was really an aha moment for me, because I realized, we've been doing this all wrong. Like, we need to kind of change our mentality and de-risk more before building anything. So I think the long and the short of it is, when Jennifer and I were doing customer development on some ideas that would help marketers, we ended up actually, I guess you could say, stumbling into this ad network for email, because in talking with a lot of marketers, a lot of people felt like, well, it's, actually one of the best performing channels that we're getting is in email, taking out email sponsorships and whatnot. But there are all these challenges, A, B, and C, and I have to go and find these newsletters and do these negotiations and all this stuff and send the money and whatever. So that's how we actually ended up building out LaunchBit. It was kind of after, having lots and lots of conversations with marketers.
Okay. What exactly did LaunchBit do? Was it like a two-sided marketplace where you would find the newsletters and they'd be the supply, and then you'd have, the buyers who want to place ads in these newsletters? Is that kind of a rough summary?
Yeah. So our first version of it was exactly that. And I guess you could say it's like the BuySellAds version for email as a channel, for what they were doing with blogs. Eventually, though, we were doing, I guess you could say remnant for people in your audience who are familiar with ads. Like, sometimes when publishers cannot sell their ad slot, you'll still see ads in there anyway. And those backup ads are paying less. So once we had our publisher base on both sides,
That's right.
then once we had our publisher base on both sides, then we were able to also introduce remnant ads where we would pay on a cost per click basis to our publishers as well. So we had both, actually.
Okay. So was this the first kind of, like you said, you'd studied Eric Ries's sort of initial article about the lean methodology and having an MVP and that's sort of customer centric, or even, getting a sale, making some money centric form of a startup. It is funny you say that, because I can think back to my own thought process as an entrepreneur. And I think you get a bit distorted sometimes if you're reading a lot of press about venture-backed companies. You start to think that you don't need a customer. That's not your goal. It's really just about having an idea, getting some backers, and then growing. Not sure what you're growing. It might just be your team, but you're working on something which isn't necessarily generating revenue by actually making sales. So was that kind of what you just explained, that initial version of an ad network, was that the first time you really built, I guess, a company that actually had customers and you're proving the idea, basically? Besides the agency, I realized the agency you would have had to have had customers.
More or less. And I think the additional thing I would add here is we started getting customers from day one without building anything. So we didn't have a website in the beginning. We didn't have payments. We were literally manually brokering, like an agency, ad placements in publishers. Oh, wow. So we would go to our marketer friends and acquaintances and say, hey, do you want to buy ads in these publications? It's this price, etc. People would send us their copy in email. They PayPal'd me money to my personal PayPal account. That's how we tested the initial version. So it was very janky, but it worked, and we started making money that way. And then we started building out things once we hit bottlenecks. So for example, at some point people said, I'm getting really frustrated and annoyed by having to send you all this copy. It's just really annoying for the formatting and whatever. So that's when we started building out interfaces. And so at first it was, okay, here's a form. You can upload your copy here. Okay, now we have payments. You don't have to PayPal me money anymore. And so we just started adding things from a tech or product perspective once we knew that that was what we needed to build. In fact, so our initial version was very much like a two-sided marketplace with set pricing. But eventually we had dynamic pricing on a cost per click model. And with an auction even. And building out a full-fledged ad auction is complex, and Google has a lot of people spending many hours working on this, right? So there are many variations you can do on that. We didn't want to build anything on day one if we were going to have to scrap it. So on day one, when we were testing our CPC model, we had a form, and it had an input box for people's bids. But when you bid, nothing actually really happened. Like, it would just send us an email saying, oh, Yaro has sent us this bid of $1 per click. And my co-founder would then, based on the bid, manually on her notepad, just like readjust the number of impressions you would get in the back, like on the back end. And so it was annoying when marketers would change their clicks or their CPC bids like every few hours. Like, I'm not bidding $1 anymore. I want to bid like $5 or whatever. Yeah. But that's how we tested it. And then we decided to go whole hog on that once we noticed actually marketers really liked that.
Interesting. So I'm trying to, like, it sounds very manual, obviously, what you're doing there. I mean, the front interface looks like a SaaS, but it's really not. And the bigger you get, that's just not going to be sustainable, obviously, right? So I'm trying to visualize too, because this is a dynamic marketplace. So you have to actually deliver the ad at some point as well. And then there's like a cost per click basis. So you have to then go back and figure out how many clicks were actually generated from the ad. It sounds like a lot of manual paperwork. Can you fast forward? How does that turn into an actual SaaS? I guess is my question in terms of a company.
Yeah, well, I mean, I think with sort of running with this philosophy of, all right, first you de-risk manually and then you start building out. So once we figured out marketers really like the cost per click model, and here's why. I mean, I think it's very intuitive, but when we were charging a flat fee, let's say, to get into Yaro's network or publication, a couple of things happen. One, the pricing doesn't work for everybody. It only works for some advertisers, and sometimes you get those advertisers and sometimes you don't. And the other thing is people start to skirt you, right, in a marketplace model. So now that it's much better to go directly to you with your pricing if you know, oh, this is where I want to be. And so to kind of solve for these two problems then, cost per click works better to fill the extra remnant. Like you as a publisher still want to get the flat fee because that's premium pricing. But usually if you can't fill it, like there's literally nobody who wants to buy it, it's a waste of your ad slot unless you're running your own ads in parallel. So we can fill it for you at these high CPCs and based on how much people bid. And then based on the engagement of the bids, we can optimize that revenue for you. And so that's why that works. And that's why Facebook and Google and all have a CPC model, because it's more efficient for everyone when you can't get sort of those premium advertisers. So we were able to quickly validate that. And then so we just started building out, the components to reduce friction again. So initially it was, all right, let's build out tracking. That was the first thing, because we needed tracking for all of them in order to charge advertisers, right? Like, you got 51 clicks and this is what you bid, so here's your bill. We needed to, and once we did that, we also needed to, make sure that we were tracking engagement. So that way we were also optimizing who actually is the best ad. So just because you bid $1,000 per click, if you get no clicks, that's not helpful versus somebody who may bid only 50 cents per click. But if everybody's clicking, that might be way more money, right? So we had to start figuring out, okay, how to optimize for engagement to maximize revenue. And so all these things, we started just building them as they came in the order of what was most necessary and what's sort of a nice to have.
Okay, and is this the time when you actually get investors for the company?
Yeah, so we got investors. So we went through the 500 Startups Accelerator program, and we got investors more or less right after demo day with the original version of the ad network. We had already started making money just by collecting manual payments through my PayPal account. And that was on the flat fee model.
And that was enough to get you into 500 startups, and then you went from there. Now, you actually became a partner at 500 Startups, too. Is that sort of the introduction to that world for you as well, as initially as a participant?
Yeah, so later I did, but that is how I got to know them, actually, by being a company that went through one of their earliest batches.
Okay, so take us through that. So you participate in 500 Startups, complete the program, you get their initial backing, but you also go through a pitch day as part of the 500 Startups process. You pitch, then you follow up with potential investors, and hopefully you get your seed round out of that. Is everything I'm saying what happened with you guys with
That's
LaunchBit?
right.
Yeah. Okay. So you exit
That's
it. Right. You get your funding. You build a team, I'm guessing, as well, and then you're trying to systematize and use software to take these manual processes and turn into an actual SaaS. I'm assuming you were the first engineer. Is that right for the company?
Yeah, so what ended up happening was my business partner, or my co-founder, Jennifer, who is also technical, we decided we would divide and conquer. So she built out product, and I went and sold ads.
Okay. Oh, yeah. So you didn't use your engineering side so much in that one.
No.
Take us through with LaunchBit to the point where it actually came to the acquisition, the sale of the company. Was that a situation where you were looking for that, or someone knocked on your door, or you were actually looking to, raise more capital? That sometimes can initiate an acquisition as well. What was the timeline for that?
Yeah, I guess kind of all of the above. So one, because we had been in this space, obviously it attracted sort of the attention of some of the other ad networks, including BuySellAds. So that's actually how I'd gotten to know Todd, just by being in market, whom I think you mentioned was on your show.
I should say Todd Garland is his last name, in case you're wondering.
Todd Garland,
yeah.
CEO
Yeah.
and founder of BuySellAds. Yeah. And so I got to know him over the years. And then actually at some point, BuySellAds became a partner. So in this world, I think just going back and explaining a little bit, again, with a cost per click model, you can make extra money when there's extra ad inventory. Otherwise, you don't get anything, and that space is lost, right? Well, to get more of that, what ad networks often do is they often will partner with other ad networks. So it's funny, a lot of people think ad networks are very competitive with each other, and to some extent there is some competition, but there's also a lot of cooperation because somebody always has space that's unfilled. And so we started partnering with them to fill their extra space and doing a revenue share that way. So that's actually how we really got to know each other, I think, even from a business perspective through that partnership.
Okay.
And then fast forward a bit. So I think at this point in time, like I was trying to raise more money. Honestly, I couldn't raise really anything more, or at least not at the terms that I was hoping for. And meanwhile, we had been just sort of casually discussing what something more strategic might look like with BuySellAds. And so that's kind of how the two happened more or less in parallel. And we ended up being acquired by BuySellAds in 2014.
Okay, so it sounds like the situation meant that you weren't looking at an acquisition where you're getting, lifetime retirement money out of that transaction. But did you stay on at BuySellAds after that, running LaunchBit for a while, or did you exit when it exited?
I exited when it exited. So BuySellAds. So the way acquisitions kind of work is like people, want product or team or your customer list or whatever, some permutation, depending on how strategic it is or whatever. BuySellAds wanted the product. They wanted it to be as part of their family suite, and they ran it for about 4 years. And there are pieces of it that are still integrated with their system today. But they didn't want us. They had, better ad salespeople than me, and they had their own processes, right? Because they can sell ads as an additional product alongside their other ads. So they didn't need other people. And so we left, the team left.
Oh, wow.
And this was actually something that we wanted. My co-founder really wanted the autonomy to be able to either start something new or do something else or whatever. And so that was something that was really important to us. So she actually put together, not for this acquisition, but all these years had put together a large Google Doc, to her credit, like actually spelling out every single thing you needed to do to run our business. And so we just handed that over. And we had a 2-week period that was negotiated in there with BuySellAds where we would be there to kind of help handhold them in onboarding them onto this. Day one, they read the book. They were like, okay, we've done everything just by reading this book, so we don't think we'll need you for the next, whatever,
Wow.
9 days.
Wow, that is the fastest exit, like an actual exit I've ever heard of. I think most of the time there's at least some kind of handover period, but credit to Jennifer for the best SOP ever written by the sounds of things there. So you're out, you're free. Correct me if I'm wrong, but like I said, you didn't have retirement money, so you're still thinking, what's your next bet? What happened next?
Yeah, so I really wanted to figure out, okay, what should my next business be? Like many entrepreneurs. And I think in particular, after having gone through all this, like one of the soul searching moments for me was, it's not enough for me to find a problem where you can make money. I think for me, I really want a problem that I would want to continue working on and serve that audience for the next 30 years. Like basically that would be my last business. I didn't want to have a business where I would sell again. So I was doing a lot of soul searching, trying to figure that out. I went to mentor at 500 startups where initially I started out there as an EIR. And then one thing led to the next, and it was actually really fun being there. And so I actually got sucked in and ended up running their accelerator program there for several batches and becoming a partner there. That was not the path I had intended on. I never thought about venture, never wanted to go into venture, but it was just actually so fun and I really loved their mission. So that's how I ended up there.
Okay. I've always been curious when someone becomes a partner at an incubator / early stage investment firm like 500 Startups or YC or whatever. Partner to me infers some sense of you're on the cap table through the 500 Startups entity. Can you maybe explain whatever, I don't know what you're allowed to talk about in terms of that, but what does happen when you become a partner?
Yeah. So accelerators also have their own funds. So you do get carry in those funds. Now, obviously, you don't get carry in all the funds, only, kind of when you're there. And there are, just like actually vesting for startups, there is vesting, whether it's at a VC fund or an accelerator for people who stay at funds or accelerators as well. So I was there for about 3 years. So I had, 3 years of vesting, but vestings on funds are typically like 7 years. So, I think that unless you're with a VC fund or an accelerator for, call it a decade or more, or unless the fund really knocks it out and you're being there for 1 to 2 years makes a difference. I think in the end, it's not actually quite the same as if you end up at a unicorn startup and you're early and you vest for 1 or 2 years.
Okay.
It's not quite the same, because think about it, like a fund is diversified across many winners and losers too.
So just want to get my head around it here. So help the audience too. So if you stayed, let's say, at 500 startups for 10 years, so you start, you become a partner. Now, the day you become a partner, that means you have a percentage ownership of the fund that is 500 startups, right? Which is the fund that's paying out the $100,000, whatever it is, per startup to get 6 or 7% or whatever it is through the accelerator program. And then any follow-on investment that might happen as new rounds are raised. I don't know how far 500 startups goes, but at a bare minimum, you're in with that initial, 6%. Then sometime 7, 8, 9 years later, as those few winners start exiting, the fund is returned, the carry is returned, and then you have a percentage of whatever that is as a partner based on the time frame you were a partner in the fund. Does that kind of summarize it, right?
Yeah, so if we walk through this pretty quickly and concretely, let's say you have a $10 million fund, and let's say in 10 years, let's just say for easy numbers, the fund is a 2x fund. So meaning it returns 20 million in total. So what happens first is the investors in the fund get their money back, the 10 million. And then the 10 million of profit is usually shared with an 80%, 20% model, meaning the investors get 80%. And the managers of the fund get 20%. So in this case, with this scenario, there would be
2 million.
Sorry, 2 million left for the team, the managing team. And then on top of that, there's a percentage of how it's divided up amongst the team. And so let's say that you are 10% owner on that, then you get 200,000. But that is also subject to vesting, how long you have vested for. So if you've only vested half the time, now you're talking about you get 100,000.
Okay.
So you see, it just keeps getting smaller and smaller because like most of it goes to the investors, which I think rightly it should. But
sorry, I just lost your audio track just for a second there. What did you say? The last 10 seconds?
Oh, okay. So yeah, you can see that this starts to shrink more and more. Most of it goes to the investors of the fund, which I think rightly it should be. But I think even amongst the team, there you get some percentage, and then depending on how much you vested, a percentage of that.
Yeah. Okay. So it's yeah. It really requires some unicorns and some big results for you to even get a reasonable outcome, since it's so many slices of the pie happening there. Okay, so take us forward. Your exit, your partnership from 500 startups. Is that what connects you to Hustle Fund, what you do today?
Yeah, so I left in 2017 at 500 startups. A number of things happened there, but I think in parallel, I was also starting to think about starting my own fund. And in particular, I think I loved the 500 startups ethos. It's actually very similar to what we believe at Hustle Fund as well, which is, they were investing globally in all kinds of founders working on all kinds of things. Like they very much, I would say, were some at the forefront of, this idea that entrepreneurs can come from anywhere and can look like anyone. And that's very much what we believe at Hustle Fund as well. But I think one of the things that I really wanted to do was I wanted to invest quite early. So that may sound funny because you may say, well, they were an accelerator, weren't they, quite early? And I think at that time, actually, in 2017 or thereabouts, a lot of accelerators, not just 500, but also YC and Techstars, a lot of the companies going into these programs had a fair bit of traction. It was not uncommon for a company to have already gotten to about $10,000 per month in revenue at any of these programs, at any of the top programs. And this makes sense because as these programs had developed a brand, they would attract great companies, including companies that were not only great, but also had great traction. And so if you could, you pick companies, like a lot of them picked later stage companies. Well, I really wanted to be able to solve for pre-seed, is what I call it, companies that didn't have any traction. In fact, that was more or less the kind of company we had at LaunchBit. We went into 500 startups with very, very limited revenue. And I felt like there was sort of this huge gap. And others had noticed it as well. Like, I think somebody whom I consider to be both a mentor and a peer of mine is Charles Hudson, who runs a pre-seed fund called Precursor. And he had just gotten into the market around that time before I took the leap. And I thought that was really clever. There was just this dearth here where people were stuck, entrepreneurs were stuck. And all these firms that had made a name by, investing in napkin-based ideas had vacated the space. Like Felicius used to invest that early. Now I would say they're squarely a Series A fund. So once you get success, you vacate the earliest stages. So at that point in time in the market, I would say there was kind of more or less nobody, and Charles was just getting started.
Again, I lost the last 2 seconds of your audio. I got the impression though. Okay, so and just to make this make sense to everyone, obviously there's a need for funding for early stage at that early stage before they have necessarily got traction. But what's the reason for you to do that? Because correct me if I'm wrong, that's possibly the single riskiest time to make an investment because it's completely unproven. You're probably basing it on the founders, which, early stage is almost based on the founders, but at least with traction, you can see that they're getting somewhere. And I know a lot of people who have great ideas who might be researching, doing things, but at the end of the day, they never even start a company out of it. So why do this, and what's in it for you as a firm?
Yeah, it's a great question. So there were a couple of things I noticed while at 500 Startups, which is why I thought that this was even a good idea. Because many people thought this was a horrible idea. Like, why would you want to invest in companies without any revenue traction? So one is, I noticed that companies with traction at the seed stage, it didn't necessarily mean that they had product market fit or even were on their way to product market fit. Just because you have one customer who's paying you a lot, it doesn't mean that it's repeatable. Or just because you were able to get these other people in an agency-like way, which may be fine in the beginning, it doesn't mean it's repeatable. And yet, I think for most VC firms, in some sense, they were paying up in valuation for that traction. And especially since we were starting to see pressure on seed valuations rising. But on the flip side, at that time, pre-seed actually, pretty much had no investors at that time. And so valuations were actually quite low. Now, obviously, the world has changed a little bit today, but valuations were quite low. But to me, the risk is actually the same between pre-seed and seed. Namely, they both had the same risk of there's no product market fit, and it's unclear if there is going to be product market fit. So if the risk is the same, because I would argue that product market fit is the number one most important risk that everyone needs to consider. It's actually not execution or founder risk. Okay. It is product market fit risk, which is a lot of luck as to whether you stumble into an idea that actually can get product market fit. Then I would much rather take the earlier company, which is, could have a valuation of 2 to 3x lower, or put another way, your multiple, if it goes well, could be 2 to 3x higher. So it is, in some sense, easier to get the economics to work out. You're taking the same level of risk for a higher potential multiple. So that's what I saw. And then the second thing is, in running the accelerator, we felt like we had a model that could also help with this. And this very much goes to what we're working on at Hustle Fund, which is we actually try to make a decision within 48 hours of speaking with an entrepreneur for $25K. And that allows us to get capital in there. Entrepreneurs can start raising. We start helping them raise more money, etc. But it allows us to start working with the entrepreneurs. And in some cases where it's a good fit both ways, we may decide to invest more money. And this is something that we learned kind of from the Accelerator 500 Startups, which is I realized I didn't learn very much about companies and hearing them pitch me. But once they came into the program and we could start to work with each other and interact with each other, I learned a lot. And so to me, actually, I felt like that is a lot more informative than hearing somebody pitch. And it's also more informative for the startup. Like they know who they're getting. So for a 25K decision, it's easy on both sides, like whether to get that deal done or not.
That's really interesting. Like you're almost doing a pre-qualification investment at 25K fast so that you can then do that sort of quality time with them to really see if they're worth further investment. And throughout this process, you're getting in at the lowest likely valuation they will have. Can you clarify? I know you said like obviously valuations right now as we are talking are definitely a lot higher than what they have been. I know I'm part of like a couple of syndicates, Jason Calcanis and Arlen Hamilton and a few others on Angel List. Just 3 years, it's gone from a $3 million raise to a $9 million raise at that first sort of valuation that I'm putting in. What are you experiencing? Like, what are you putting in now when you put in that initial 25K? What's the valuation?
Yeah, we're actually still staying quite disciplined around valuation. But I mean, people always ask me, well, what numbers are we talking about? I think it varies a lot on geography, but I would say our median tends to be between, call it 3 and 6 million post money. But we've also done deals on either end of that. So the bulk are probably in there. But that being said, I think we actually ran the numbers with our applicant pool in terms of what valuation people are asking for. And it's very bifurcated. What we found is for a lot of the hottest deals, they are getting these higher valuations than in 2020. And then they are also closing faster and raising more money. But that being said, it's not everybody. There are still a lot of companies that really struggle to get funding. And so there is a much larger range this year than what we saw last year, at least in our data.
Okay, interesting. So sort of last 5 minutes here, I know you got to run off. What is the criteria? Like if there's a listener here is thinking, you know what, I would like to pitch to Hustle Fund. What would be the best presentation to do for you, their best foot forward in terms of qualifying? Because I know we're kind of alluding to it here, but we're not, like you said the greatest risk is product market fit risk. That's hard to it's impossible to demonstrate before you've had any customers, right? So how do we impress you at Hustle Fund?
Yeah, so actually I think very similar to how we de-risked LaunchBit, that actually is the most impressive to me, having had a lot of other flounderings before, which is, can you get people on a wait list, even if you have no product? Can you pre-sell? That's even stronger. We've had some companies have no product, but they pre-sold already. Or can you start to sell while concierging a product? So maybe you don't have like I said, our manual form fields, something like that. Can you do that for your business and start attracting interest or start actually even generating sales? So that's the kind of scrappy thinking that we are looking for, like people who are very focused on the fact that, one, I know I need to de-risk whether this is really actually a problem that people are willing to pay for. So what are the things I can do to focus on that? That's kind of the line of thinking. And two, what are the small experiments I can start to do, whether they're little ad tests or, have a little event and get people to sign up or whatever. What are those things that you're doing?
Okay, interesting. So it's kind of like, are you action orientated? You're doing things to at least experiment, not necessarily talking about just having an agency client so you can show that you're doing 5,000-10,000 a month. You're actually looking to scale users through action, but not necessarily financial yet. So that's an interesting insight. Last couple of minutes, Elizabeth, what is the future here? Where do you hope? Because I know it's kind of early days. You said it's like a 7-year sort of typical life cycle. You're getting in super early, so that really might push to 10 years with a lot of your investments. You started in August 2017, if I'm reading your LinkedIn right. That means you're only at kind of a year 4 at best with your first few. Where does this go? What's happening next?
Yeah. So for the broader Hustle Fund organization, as I started mentioning at the beginning of this, we have plans to change, I think, how startup ecosystems work along those three things: capital, knowledge, and networks. And so we continue to launch other funds that are unrelated to the VC fund and run by other people, to be clear, and other programs that can, push things along with those things. So, for example, we launched Angel Squad earlier this year. My colleague Brian Nichols launched it, runs it, I should say, and he, manages that. And that is a program for aspiring angel investors who don't know anything and may not have a lot of capital. Our minimums are $1,000 investments. And it allows them to learn more about angel investing, also allows them to invest alongside us, et cetera, and to introduce more capital into startup ecosystems. So we're trying to attack this problem from many different angles, and the VC fund is one, and that's the one that I'm focused on. But for the broader org, you'll see a lot coming out from us.
Okay, so it sounds like it's about reaching as many people or quality people around the world who are entrepreneurs as you can and supporting them as best you can.
Definitely.
I missed your answer. The audio cut out, but I'm pretty sure it would have been recorded. So I think I know what you were alluding to, but it was a yes, basically.
Yeah.
Okay, so website addresses, Elizabeth, where do you want to send people?
Yeah, if people want to apply, they can just go to hustlefund.vc. We do actually read every application and get back to people. 15% of our portfolio companies actually came in completely cold just from there. So that's one place. And then I think the other is just on Twitter. We publish a lot of content, tactical content on a variety of different aspects of building your business, mostly focused around fundraising and tactical customer acquisition.
Okay, well, thank you for sharing